Hey guys, what's going on? I hope you're having an awesome day. Today I'm bringing you another individual stock analysis. We're going to be having a look at Boeing, and I'm excited to talk about Boeing actually because we haven't spoken about it on this channel yet, and it's a huge corporation and a lot of you guys were asking for it. So here it is, and as per usual, just before we get started, I have to say that I am not a financial advisor and I'm certainly not your financial advisor. I don't know your personal circumstances, so make sure you do your own research and consult a financial advisor before you make any investments. Now, in this video, as per every other stock analysis video, we're going to start off with an overview of what Boeing is, what their business model is, and that sort of thing. Then we're going to have a look at the economic moat. So what kind of long-term competitive advantage does Boeing have over its competitors? And we're going to have a look at that in a qualitative and a quantitative sense. Don't worry, I'll explain what I mean by that in just a second. Then we're going to have a look at the management's effectiveness, and we're going to have a look across two dimensions as per usual, how they invest their capital and how they're managing their debt. Then we're going to jump into the value matrix. What kind of return can we expect to get over the next 10 years if investing in Boeing, and depending on what kind of performance Boeing shows us. And lastly, of course, we're going to come to a buy, sell, or hold decision based on a number of things that we're going to make, a number of assumptions that we're going to make. Hope you enjoy this one. If you do, make sure you become a subscriber, join the team, and join us as we go on this stock market journey. And if you have any suggestions for individual stock analysis, make sure you leave them down in the description below because I will be making these videos every single week. So let's start off with that overview of what Boeing is. What is the company and how do they make their money? So basically, they're an American multinational corporation that designs and manufactures and then sells aeroplanes and other kind of crafts and satellites and that sort of thing, missiles, and they do this on a commercial basis as well as on a defense basis with the government, and I'll explain that in a little bit. But essentially, this company is a massive business that's been around for over 100 years. They were actually established in 1916, and fast forward 100 years into the present day, they've currently got a market capitalization of over 200 billion. So it's a massive business in the United States. As of 2015 data, they are currently the second largest defense contractor for the United States, and they're also the biggest exporter of goods from the United States in terms of dollar amounts, and that's simply because they're dealing with such expensive equipment. It's going to add up to a lot when you're selling airplanes and that sort of thing, so they've actually managed to be the biggest exporter in terms of dollars from the United States, which is very impressive. Alright, so that covers basically what the business is, but how do they make their money and how are they bringing in all of that revenue? And essentially they operate in a number of different divisions. I think there's 6 or 7 divisions, but there's 2 main divisions that most of their revenue come from. The first is Boeing Commercial Airplanes, and the second is Boeing Defense. And I think both of them are pretty self-explanatory, but essentially, as I mentioned earlier, they design these airplanes and missiles and satellites, they manufacture them, and then they sell them to these businesses such as commercial airlines or the defense being the government. So now that we've established what Boeing is and how they make their money, we want to see if there's some kind of intrinsic characteristics about it that are going to ensure that it stays a long-term competitor in this marketplace. And essentially, we want to do what's called a qualitative and a quantitative analysis. We'll start with qualitative. When I say qualitative, I mean we're looking for some kind of quality or characteristic about the business that we can identify as an investor and see that that is going to allow them to remain competitive over the long term. An example of this, and an easy example of this, is a branding moat, which means that their brand and their reputability is what is going to allow them to stay majorly competitive in this marketplace. And I think that definitely applies for Boeing, as Boeing airplanes are known as being highly reputable and they're used in across many commercial airlines, and they're also used in defense. So it definitely has that strong moat of branding, and that people see the Boeing airplanes and they know that that is going to be a reputable airplane. They know what they're getting and the quality and the kind of level that Boeing is operating at, which is going to allow them to remain competitive. But there are a number of other qualitative moats that sort of assist that moat in creating this massive competitive advantage that Boeing has over its competitors. That second kind of qualitative moat that I'm talking about is the barriers to entry in this kind of industry. It's very hard for smaller businesses to come into this space and try and operate because really it's not easy to be profitable in this space unless you're operating on a mass scale. So businesses like Boeing that have been able to build up a massive operation over the past 100 years have a huge advantage against smaller businesses trying to compete, and it's virtually impossible for them to come into the space and take any kind of market share from businesses like Boeing, just because in order to get to a profitable space, you need to be operating in a huge market. You need to be manufacturing millions and millions of dollars of planes, billions of dollars worth of planes in order to be profitable. So that's another advantage that Boeing has over newer competitors, anyone that's coming around in the next 10 or 20 years. So once we've done our qualitative analysis, we want to see if this is backed up in the numbers. If what we hypothesize are the advantages that Boeing has, which is their moat and their massive scale, being in a market that has a high barrier to entry, we want to see if that's backed up in the numbers, and that's called a quantitative analysis. And there's four main numbers that we always look at and that I always look at in this individual analysis video series. We look at the sales or the revenue, the earnings per share, the equity, and the free cash flow. And we look at those areas because they give us a broad representation of how the business is operating, how their performance has been over the past, and what kind of performance we can expect in the future. So if we come over and have a look at these numbers, we can see that sales growth over the long term has been about 5%, and that's been slowing down recently. And this year they actually had a decline in revenue, so not a huge amount of growth in terms of revenue. In terms of EPS though, their long-term growth is almost 15.5%, which is great, and each and every year it has been improving, which is exactly what we like to see when we're looking at these numbers. We want to see all of them with a very high number at the end, at the long-term number, and then also growing over time, so we can see that their performance has been getting better and better and better. In terms of equity, it's been severely damaged over the past 10 years, going down and down and down. And this company is a business that doesn't really operate with much equity. They fund most of their operations through debt, and they have large amounts of debt just because of the kind of business that they're operating in. But I generally don't like to see equity like this, because equity for me is what is the intrinsic value of a business. It's what their assets are worth once you get rid of pay off all the liabilities and pay everything down. It's what's left intrinsically for the shareholders. So I like to see this growing over time. However, if you look into this business a little bit more, you might discover that equity isn't as important in this kind of business. I don't know that because I haven't looked into Boeing in a great detail, but if you're going to be investing in Boeing, you want to make sure that you know what they're doing with their equity and what their plan is for returning value to the shareholders. And lastly, we have free cash flow, which has been growing very quickly over the past 7 years. As you can see, we don't have that 9-year number because they did have negative free cash flow before that. But free cash flow is very important. We want to see that they have enough money left over after their operations in order to make new investments and sort of grow the business. And seeing them at such high numbers is a really good sign. So the next important component that we want to look at is how effective management is at working for us. And I like to look at this over 2 dimensions. The first is how good are they at investing capital within the business, making investments internally in order to grow the business. And then I like to look at how they're managing their debts. We'll start off with the capital. And of course, as always, I like to use the ROIC, which is the return on invested capital, to see how effective they've been at investing within the business. So the 5-year average for Boeing has been just under 50%, which is insane. That's a really strong ROIC. And if we compare that to the industry average of 18%, you can see that Boeing has been able to vastly outperform that. And in the last year, their ROIC has been 86%, which again is really high. And the industry average of just under 15%, it's vastly outperformed that as well. So management is doing a very good job at taking its investments and producing income on those investments. And then of course the other dimension is that we want to see how effective they've been at managing debt. First, we look at short-term debt through the current ratio to see if they're easily able to pay off their current liabilities, their current debts that are going to be coming up in the next 12 months. For Boeing, they've got a current ratio of 1.16, so they've got about 16% more assets than liabilities for the next 12 months. So they will be able to cover that, but they're not covering it easily. I like to see a current ratio of 2 or more. However, as long as it's above 1, it's a good sign, and a lot of people use 1 as the minimum so that there's at least enough assets to cover those current liabilities. Then we want to have a look at long-term debt and the big debt picture by comparing the debt to the amount of equity. The debt to equity ratio for Boeing is 260, which is insanely high. I like to see a debt to equity ratio of 0.5, and as I mentioned earlier, equity is an area that I like to see growing over time, and I like to see a lot of equity in a business. So Boeing probably wouldn't be one that I would go after personally. However, if you look into the business and you understand how it operates and why they operate with such large amounts of debt and such little equity, then it could be a great investment, and that debt to equity ratio could be completely irrelevant. All right, so now that we've assessed the business and got that out of the way, let's see what kind of return we can expect to get over the next 10 years if investing at the current stock price. So to do that, we're going to have a look at my value matrix. And by the way, guys, if you want access to this spreadsheet, it's completely free and you can use it. It's got all the formulas in there for you, and it's really, really helpful when doing this kind of analysis. The link to it is in the description below, and there's also a video on my channel explaining how to use every aspect of it. So I suggest you go check that video out as well so that you can use the spreadsheet to its maximum potential. But let's go have a look at the value matrix to see what kind of return we can expect to get. So essentially how this value matrix works, if you don't already know, is that we take a range of growth rates and a range of PE ratios, and we come up with a variety of potential outcomes for this stock. So we're looking at potential stock prices in 10 years time. What could the stock price be? So for Boeing, I've said that we can expect that their earnings per share is going to be able to grow at somewhere between 5 and 20%. I think it will probably be in the 5 to 10% range, maybe around the 10% range over the next 10 years, but I've included some higher ones as well to see what is possible if the company does really outperform. So as you can see from the bottom table, with those ranges of growth rates and ranges of PE ratios, and those PE ratios are just the average PE ratios that Boeing has had over the past 5 years. It comes up with a bunch of prices in 10 years time, and you can see that those prices range from $367 per share all the way up to $2,700 per share. So I think that the stock price in 10 years time will be somewhere between there, and in all likelihood it will be somewhere in that 700, 800 range. Then if we go have a look at the top table, we can see what kind of return we would get each and every year if we bought at the current price and if the stock performed in a certain way. So for example, if the stock does 10% EPS growth each and every year from today, and they have a PE ratio of 21 in 10 years time, we will earn a return of 9.31%. So from that you can see that there's not a whole lot of downside as long as it performs at least 5% per year. And there is some upside, however, the expected return that we would make is probably somewhere in the 5 to 10% per year range. But that's not horrible, because remember, we're just talking about stock price appreciation here. We're not even talking about a dividend. And Boeing pays a 2% dividend at the moment. So if we expect that we can make a 2% dividend, 2% plus a 9%, 9.3% gives us an 11.3% return, which is a very good return, expected return to get on a business that's so big and so reputable. So lastly, we want to come up with a buy, sell, or hold decision. And to do this, we need to make a couple of assumptions. The first assumption I'm going to make is that the growth rate for this company is going to be the same as their long-term equity growth, which has been 15.5%. So we're going to assume that. We're going to assume that they're going to have a PE of 21 in 10 years time, which is the PE ratio that they've averaged over the past 5 years. Then we need to assume what kind of return we want to make from this stock. And I've said that we want to get a 2% return from the dividend and then a 13% return from the stock price actually appreciating. So in total, we're going to get 15%. Then if we plug those numbers into our calculator, our buy zone calculator, we come up with a future or a fair value price of $420 per share, which is great because this current stock price is about 360. So it's actually above the current stock price. However, with our margin of safety rule, we have to pay 50% of that fair value so that we can allow for errors in our valuation and for the underperformance of the stock. So we would only be willing to pay 50% of 420, which is $210 per share, which is a dramatic decrease from the current stock price and something we may or may not see anytime soon. But for me personally, I think that this company is a little bit overvalued, or not that it's specifically overvalued, as we just saw that the stock price is less than the fair value. It's just that it's not cheap enough for me to get a certain good deal from it. I only want to be investing in businesses where I'm certain that I'm going to make my 15% per year. If you enjoyed this video, make sure you become a subscriber and join the team and hit that notification bell so you get notified every time that I'm posting. I'm going to be doing these individual stock analysis videos every single week on Tuesdays from now on, and I'm also bringing out my new episodes of the YouTube stock portfolio every single Saturday. So make sure you're subscribed so you don't miss out on those. And there's also going to be some other videos sprinkled out in between. I'll also just mention that if you like longer form discussions about finance and the stock market, then you might want to go check out myself and Brandon's new podcast, the Young Investors Podcast. It's on the Aussie Wealth Creation YouTube channel, and it's also accessible on iTunes and on Spotify. And I think it's coming out on Google Podcasts pretty soon. And basically we just talk for 45 to an hour about different stock market topics, and we also break down individual stocks in those podcasts too. So if that's something that you're interested in and hearing a bit more of a longer form discussion about these kind of concepts, then I recommend you go check that out. But for now, I hope you guys have a great day, and I'll see you in the next one.